Something has changed in the plumbing of the American financial system. It did not change with a dramatic announcement. It did not change with a senator standing at a microphone. It did not change with a public warning that ordinary people could clearly understand. It changed quietly through guidance, compliance systems, reporting rules, bank procedures, software upgrades, and incentives that most people never see. And when a system changes quietly, the people who get hurt first are usually not the sophisticated people. They are the people who still behave as if the old rules are the current rules. That is why the $10,000 bank rule is so dangerous. Now, most Americans think they understand it. They think it means that if you deposit or withdraw more than $10,000 in cash, the bank files a report. They think the report is routine. They think nothing really happens unless you are doing something wrong. That way of thinking is out of date. In the last couple of years, the system around that rule has become broader, faster, more automated, and much less forgiving. The number is still $10,000, but the world around the number has changed completely. The result is that an ordinary retiree moving ordinary money for ordinary reasons can now be delayed, reviewed, reported, questioned, flagged, and sometimes pulled into a process that feels completely out of proportion to the transaction. This is not because every retiree is suspected of being a criminal. It is because the system is designed to detect patterns, reduce institutional liability, and feed information into federal databases. Once that system sees a pattern that looks unusual, it does what systems do: it moves. And systems do not care whether your intention was innocent. I have spent my life studying how systems work, especially financial systems. The most important thing I learned is that bad outcomes usually do not come from one big event. They come from a series of small rules, small incentives, and small misunderstandings that compound until an ordinary person is suddenly trapped in something they did not know existed. The $10,000 rule is exactly that kind of system. The danger is not just the report. The danger is the widening circle around the report. It is the senior withdrawal delay. It is the structuring trap. It is the way digital payments are being pulled into reporting pipelines. It is the pressure businesses now face to report large cash transactions involving you. It is the fact that the threshold has not been adjusted for inflation since 1970. And when those pieces combine, a rule that once targeted extraordinary cash activity begins touching normal life. That is the part most people miss. This is not a warning about a future law that might pass someday. This is about a reality that is already affecting people. Now, it is affecting people in bank branches, car dealerships, contractor payments, family transfers, digital payment apps, and ordinary retirement transactions. To understand the risk, it helps to start with a simple story. Imagine a couple named Martin and Carol. Martin is 71, Carol is 68. They are not reckless people. They are not gamblers. They are not moving money through strange accounts. They are the kind of people who worked for decades, saved carefully, avoided unnecessary debt, and believed that if they earned their money honestly, they could use it when they needed it. Martin spent his career managing a regional operation for a paper distribution company. Carol worked as a nurse for many years. They lived comfortably, not extravagantly. They had savings. They had a bank they trusted. They had the kind of financial life that looks boring, which is usually a good thing. Then they decided to replace Carol's car. They had the money. They did not want to finance the purchase. They negotiated the price, brought it down, and decided to pay in cash. From their point of view, this was conservative behavior. No debt, no monthly payment, no financing charge, just a clean transaction using money they had already earned. So Martin went to the bank and asked to withdraw a little over $40,000. That is where the system woke up. The teller did not simply count out the money. The request moved into a review process. A manager came out. Martin was asked to step into a private office. Then came the questions. Why did he need the cash? Had anyone told him to withdraw it? Had he received any phone calls, emails, or text messages asking for money? Had he met anyone new online? Was he under pressure? Was someone else waiting for the money? From a human point of view, Martin was a capable man buying a car for his wife from the bank's compliance point of view. He was a senior customer asking for an unusually large cash withdrawal that did not match his historical pattern. That distinction is everything. The bank was not only thinking about Martin's rights, it was thinking about its own liability. It was thinking about elder financial exploitation rules. It was thinking about what would happen if it released the money and Martin turned out to be the victim of a scam. When institutions face asymmetric incentives, they choose the safer path for themselves. If the bank releases the money and fraud occurs, the bank may face serious consequences. If the bank delays the money and Martin is merely inconvenienced, the bank usually faces little or no consequence that produces a very predictable behavior. Freeze first, explain later. Martin eventually convinced the manager that the car purchase was legitimate. But the money did not move immediately. The withdrawal was delayed. He had to go back to the dealership and ask them to hold the car. He was embarrassed. He was angry. But he assumed that once he received the money, the matter was over. It was not over. A suspicious activity report was filed. That report did not mean Martin had committed a crime. It did not mean the bank believed he was guilty of anything. It meant the transaction had entered a federal reporting system because the pattern looked unusual enough to document, and once a report like that is filed, it can sit in a database for years, connected to future activity, available to be compared against other patterns. That is the part ordinary people do not understand. They think the question is, did I do something wrong? But the system asks a different question. It asks, does this pattern match something we are required or incentivized to notice? Those are not the same thing, Martin. His mistake was not criminal. It was mechanical. He moved money the way a person from an earlier era would have moved money. He assumed that because the money was his, and because the reason was legitimate, the transaction would be simple. That assumption is no longer safe. To understand why, you have to go back to the number itself. The $10,000 threshold was created under the Bank Secrecy Act of 1970. That matters because 1970 was a very different financial world. In 1970, $10,000 was a large amount of money. It could represent more than many Americans earned in a year. It could buy a substantial portion of a house. It could buy cars. It was not a normal amount for the average person to move casually. So when the government set the reporting threshold at $10,000, the number was designed to capture extraordinary cash activity. But here is the critical point. The number stayed fixed. The world did not. Inflation kept working. Wages changed. Home prices changed. Medical costs changed. Car prices changed. Renovation costs changed. Retirement account balances changed. Insurance payouts changed. Family financial support changed. The number did not move with any of it. If that threshold had been indexed to inflation, it would be far higher today. The ordinary person would not keep bumping into it during normal life. But because the threshold is frozen, more and more normal transactions are pulled into the same system originally built for unusual cash movement. This is one of the most important principles in economic systems. A fixed rule in a changing world is not actually fixed. Its real effect changes every year. A $10,000 threshold in 1970 is not the same as a $10,000 threshold today. The nominal number is the same. The economic meaning is completely different. That is why the rule now catches people. It was never originally designed to catch. A retiree buying a used car, a widow receiving an insurance payout, a grandparent helping with the down payment, a couple paying a contractor, a person moving money after a spouse dies, a family handling medical bills in the old world. Those might have been ordinary private transactions. In the current system, they can become reportable events. Once you understand that frozen threshold, the rest of the problem becomes much clearer. The first major change is the senior withdrawal delay. This is one of the most misunderstood pieces of the system because it is presented as protection. And in many cases, protection is necessary. Elder financial exploitation is real. Scams are real. Seniors do get manipulated, pressured, and robbed. A bank that sees a customer being exploited should not simply look away. But a protective system can still create serious harm when it is broad, automated, and backed by incentives that favor delay. In recent years, banks have been pushed to detect and prevent elder financial exploitation more aggressively. Many states have created safe harbor laws that give financial institutions legal protection when they delay transactions they suspect may involve exploitation. The intention is understandable. The consequence is that banks now have a stronger incentive to delay questionable senior transactions than to release them quickly. And what counts as questionable can be much broader than most people assume. It may not require a suspicious stranger. It may not require a fraudulent email. It may not require evidence that the customer is confused. It may simply require a transaction that looks unusual compared with the customer's normal behavior. If you usually withdraw a few $100s at a time and suddenly you ask for $15,000, the system sees a deviation. If you rarely move money and suddenly you ask for a large wire or cash withdrawal, the system sees a deviation. If you are over a certain age, the same transaction may be treated differently than it would be for a younger customer. That is not necessarily because the bank thinks poorly of you. It is because the bank is operating inside a risk management system. The system compares behavior to patterns. When the pattern breaks, the review begins. A review can take hours, it can take longer. In some cases, it can delay access for up to several banking days. That may not sound serious until you think about the timing. You need to close a car purchase, you need to pay a contractor, you need to cover a medical bill, you need to help a child or grandchild, you need to move money before a deadline. In those moments, a delay is not an inconvenience. It is a loss of control over your own liquidity. That is why this rule feels so disturbing to people who encounter it. They are not angry because a bank asked a few questions. They are angry because the balance of power changed without their consent. They thought the bank held their money for them. The bank behaves as if the money must pass through a compliance gate before it can be released. Those are very different relationships. The second major danger is structuring. This is the one that can create the most severe consequences because it is one of the places where innocent intention and illegal pattern can collide. Structuring means breaking deposits or withdrawals into smaller amounts in order to avoid a reporting requirement. Many people think this is harmless. They think, I do not want paperwork, I do not want attention. I will just move $9,000 today and $9,000 next week. That is exactly the kind of thinking that creates danger. The law is not only concerned with whether the money is clean, the law is concerned with whether the transaction pattern was designed to avoid reporting. That means the money can be legitimate and the behavior can still create a problem. The funds can come from a home sale, an inheritance, a pension distribution, a business sale, savings, or an insurance payment. If the pattern shows that you intentionally split transactions to stay under the reporting threshold, the system may treat that as structuring that is very hard for ordinary people to accept. They believe legality depends on the source of the money in this area. Legality can also depend on the structure of the movement. That is why the risk is so high for retirees. Many retirees are conservative by nature. They do not like triggering forms. They do not like attention. They do not like large single transactions. They prefer to move money in pieces because it feels safer. In the modern reporting system, that instinct can make the transaction look worse, not better. And the software is getting better at seeing patterns. Years ago, the most obvious pattern was a repeated set of deposits or withdrawals. Just under $10,000. Someone depositing $9,500 repeatedly would obviously attract attention. But pattern detection no longer depends only on the most obvious behavior. Systems can examine timing, amounts, accounts, counterparties, repetition, and deviations from past behavior. A series of $7,000 or $8,000 transactions may still attract attention if the pattern appears designed to avoid a threshold. Again, being flagged does not mean being convicted. But being flagged can create a review. A review can create a suspicious activity report. A report can create more scrutiny. In some cases, money can be tied up in a civil forfeiture process, even when no criminal charge is ever brought. This is the part that should make ordinary people pause. In a criminal case, the government must prove a crime. In civil forfeiture, the process can feel very different. The burden, cost, and stress can shift heavily onto the person trying to get money back. That is why the safest path is not to be clever. The safest path is to be clear. If you need to move $14,000, move $14,000 for a documented reason. Do not break it into pieces to avoid a report. A report is usually less dangerous than a pattern that looks like evasion. This is a strange but important principle. In the modern system, transparency is often safer than avoidance. The third change is the collapse of the old boundary between banking and digital payments. For a long time, many people treated bank cash rules, peer-to-peer apps, and crypto platforms as separate worlds. That separation is disappearing. Digital payment platforms, crypto exchanges, and bank transfer systems are increasingly part of the same broader reporting environment. The details vary by transaction type and platform, but the direction of travel is clear. More activity is reported. More activity is matched. More activity becomes visible to tax and financial enforcement systems. This creates confusion for ordinary people because the social meaning of these tools is casual. A Zelle transfer feels informal, a Venmo payment feels informal, a Cash App transfer feels informal, selling something to a neighbor and receiving payment on an app feels informal. Helping a family member through a digital transfer feels informal. But the reporting system does not care how informal the transaction feels. It cares about amount, frequency, classification, business purpose, and whether the payment triggers a form or review. That gap between how the user experiences the payment and how the system records the payment is where problems arise. A retiree sells a used item, A neighbor reimburses them for shared expenses. A family member sends money for a dinner or a trip. Someone receives small payments related to a hobby. Individually, each event may look harmless. Aggregated through a platform, the activity can create reporting that must be reconciled at tax time. And once money moves digitally, there is a trail. This does not mean digital payments are bad. In many cases, they are safer than cash. They create records. They reduce physical handling. They can be easier to document, but they are not invisible, and they should not be treated as invisible. The bigger issue is classification. Personal reimbursements are not the same as business income. Family gifts are not the same as sales. But if everything runs through the same account, the burden may fall on you to explain what was what. That is why mixing personal payments, side income, family transfers, and reimbursements in one digital account creates unnecessary complexity. The system may not understand your life, it understands data fields. So if you make your financial life look messy in the data, you increase the chance that someone else will ask you to explain it later. The fourth change involves the businesses you pay. This is another part many people miss because they assume reporting is only about what their own bank does. But when you pay a business a large amount in cash or certain cash-like instruments, that business may have its own reporting requirement. It may have to file a form identifying you, the amount, and the nature of the transaction. This can include car dealers, contractors, lawyers, jewelers, real estate professionals, and other businesses that receive large payments. From the business's point of view, the incentives are clear. If they fail to file correctly, they can face penalties. If they file, they protect themselves. So when you hand a contractor a large amount of cash, you are not just deciding how to pay. You are entering the contractor's compliance system. When you pay a car dealer in cash, you are not avoiding documentation. You may be creating it. When you pay an attorney or other professional with a large cash-like payment, you may be triggering a reporting obligation on their side. The important point is that breaking a related transaction into pieces usually does not solve the problem. If the payments are related, they may be aggregated, paying $6,000 today and $6,000 next week. For the same roof is not necessarily two unrelated payments. It may be treated as one $12,000 transaction for reporting purposes. And if your reason for splitting the payments was to avoid the report, you may have created the same structuring problem. Again, this is where people can unintentionally make a clean transaction look suspicious. They think they are reducing attention. They are actually creating a pattern. Again, the principle is simple. Do not try to outsmart a reporting system by making your behavior look less natural. Make your behavior easier to understand. The fifth issue is not a new rule. It is the inflation cascade created by the frozen threshold. This is the root cause. A fixed $10,000 line creates more and more friction as the cost of life rises. Think about what normal retirement looks like. Now, a car can easily exceed $10,000. Dental work can exceed $10,000. A medical procedure can exceed $10,000. A roof can exceed $10,000. A kitchen repair can exceed $10,000. A family gift can exceed $10,000. A relocation, a funeral, a down payment, a legal matter, an insurance settlement, or a retirement account distribution can all cross the threshold. These are not exotic events, they are normal life events. That is why the reporting system now touches ordinary households repeatedly. And every touch point creates a chance for delay, confusion, misclassification, or unnecessary scrutiny. The problem is not that one report is devastating, the problem is cumulative friction. A report here, a delay there, a digital payment form, a contractor filing, a bank review, a software flag, a question about related transactions, a mismatch at tax time. Each piece may be manageable together. They create a system in which retirees must be more organized than they have ever needed to be. Most people are not prepared for that. They still believe that if they are honest, the system will automatically understand them. That is a dangerous assumption. Honesty matters. But documentation is what allows honesty to be seen. This brings us to what you should do. The goal is not to evade. The goal is not to evade. The goal is not to avoid legitimate reporting. The goal is to move your own money in a way that is clear, documented, predictable, and less likely to be misunderstood by automated systems and compliance departments. The first protection is to pre-notify your bank before a large transaction. This is simple, but powerful. If you plan to withdraw, deposit, or transfer a large amount, call the bank before you do it. Speak to a branch manager or the appropriate banking officer. Explain the purpose of the transaction Ask them to note the expected amount, date, and purpose in your customer file. This does not prevent required reporting. It should not prevent required reporting. But it can reduce the chance that the transaction is treated as an unexplained surprise. Systems react badly to surprises. Institutions react better when they have context before the event occurs. If Martin had spoken to the bank before attempting to withdraw the money for Carol's car, the situation might have been very different. The bank would have known the purpose, the note would have existed, the review would have had context. That is how you reduce friction. You do not fight the system at the teller window after it has already flagged you. You prepare the system before the flag appears. The second protection is to stop accidental structuring. If you need to move an amount above $10,000, do not split it up merely to avoid a report. That sentence may be the most important practical point in this entire discussion. A report is not automatically a problem. A pattern designed to avoid a report can become a problem. So if the legitimate transaction is $18,000, move $18,000 in a clear way with a clear reason and a record. Do not create 2 or 3 smaller transactions because you think you are being discreet. Discretion can look like evasion when it is expressed through repeated smaller transactions if there is a real business reason to make multiple payments. Document that reason. For example, a contractor may require a deposit, a progress payment, and a completion payment that can be legitimate. But the documentation should make the purpose clear. The contract, invoices, dates, and receipts should match the payment pattern. The principle is not that multiple payments are illegal. The principle is that multiple payments should not be designed to evade reporting and should be explainable if anyone asks. The third protection is to use wires or other traceable institutional methods for large legitimate payments when appropriate. Cash feels simple, but in the modern system, large cash often creates more friction than it solves. If you are buying a car, ask whether the dealer accepts a wire. If you are paying a contractor, ask whether a direct bank transfer, check, or wire is better. If you are helping a family member with a large amount, document it and move it in a way that creates a clear record. A wire does not make the transaction invisible. It makes it more understandable. It shows source, destination, amount, and date. In many cases, that clarity is exactly what you want. Cash creates ambiguity. Ambiguity creates review. Review creates delay. This is especially important for seniors because the combination of age, cash, and unusual size is precisely what can trigger concern. The fourth protection is to separate digital payment purposes. If you use one account for everything, you are asking the system to understand context that may not be visible in the data. Personal reimbursements should be easy to distinguish from business or side income. Family transfers should be easy to distinguish from sales. Hobby activities should be easy to distinguish from personal gifts. The cleaner the separation, the easier the tax reporting and the lower the risk of confusion. This does not require complexity. It requires discipline. Use one account for personal reimbursements. Use another for any activity that might look like business or sales. Keep notes, keep screenshots where needed, keep records of what the payment was for. At tax time, you do not want to reconstruct your year from memory. Memory is a weak record. A contemporaneous note is a strong record. The fifth protection is to build a documentation habit before there is a problem. Most people document only after they are questioned. That is too late for meaningful transactions. Record the basics at the time they happen: date, amount, source of funds, recipient, purpose, related invoice. Contract, receipt, or note, you do not need a complicated system. A spreadsheet is enough, a notebook is enough, a folder with receipts is enough. The key is that it must exist before anyone asks. When a transaction pattern is questioned, the person with clean records is in a very different position from the person who says, "I think I remember why I did that." Systems respect records, they do not respect vague recollection. This matters especially with structuring concerns. If you can show that payments were made according to invoices, medical schedules, contractor milestones, or documented family needs, your position is much stronger. The sixth protection, and the one many seniors do not know to ask about, is a senior banking authorization or trusted contact arrangement. Different institutions use different names and processes. But the idea is straightforward. You create a written instruction with the bank that identifies trusted contacts and common transaction categories that are normal for you. You tell the bank in advance what kinds of large transactions may occur in your retirement life: car purchases, medical expenses, home repairs, family gifts, travel, moving expenses, insurance payments. This does not remove the bank's compliance obligations. but it gives the bank a established context and a person to contact before delaying or escalating a transaction unnecessarily. For seniors, this can be extremely valuable. The goal is not to surrender control. The goal is to prevent an automated concern from turning into a blind freeze when a simple phone call to a trusted contact could resolve the question. Martin and Carol did not have that structure in place when they tried to buy the car. After the incident, they created a clearer banking file and trusted contact process. Future large transactions were easier because the bank was no longer seeing them without context. That is how good systems are built. You do not wait for the crisis, you design the process before the crisis. Now step back and look at the whole picture. The $10,000 rule is not just a bank rule, it is a network. Banks report, businesses report, digital platforms report, software detects patterns, compliance departments reduce institutional risk, federal databases store information, tax systems compare forms, and ordinary people sit inside that network, often without understanding that their behavior is being interpreted by machines and institutions according to rules they never learned. That is not a political statement. It is a system statement. When a system becomes more complex, the penalty for being disorganized rises. The wealthy often understand this because they have accountants, lawyers, financial advisors, and staff who create process around money movement. Ordinary retirees often do not. They rely on memory, habit, and the way things used to work. That gap is dangerous. If you are moving meaningful money in 2026 the way your parents moved money in 1970, you are operating from an outdated map. The territory changed. That does not mean you should be afraid of your bank. It does not mean you should avoid legitimate transactions. It does not mean you should hide money, split money, or try to be clever. It means you should behave like a person who understands the system, pre-notify. Document, avoid artificial splitting, use clear payment channels, separate personal and business-like digital activity, create trusted contact instructions where appropriate, keep records before you need them. Those are not complicated moves, they are not dramatic, but they can prevent a great deal of pain. One of my core principles is that pain plus reflection equals progress. But it is better to learn from other people's pain when you can. Martin and Carol's pain came from believing the old system still existed. They were honest, they were careful, they were financially responsible, but they had not adapted to the new rules and incentives around their money. That is the lesson. Being honest is necessary, being clear is also necessary, being documented is also necessary. Being prepared is also necessary. The government is not going to adjust your behavior for you. The bank is not going to explain every rule before it affects you. The software is not going to understand the story of your life unless your records make that story visible. So you must build the process yourself before the car purchase, before the home repair, before the medical bill, before the family transfer, before the insurance settlement, before the account review, before the freeze, because the worst time to learn how a financial control system works is the moment it stops you from accessing your own money. The $10,000 threshold is not getting more generous. The reporting environment is not getting simpler. Digital payments are not becoming less visible. Banks are not becoming less cautious about senior exploitation risk. Businesses are not becoming less careful about filing obligations. The direction is clear: more data, more automation, more reporting, more institutional caution, more burden on the individual to explain. That is the world we are in. And in that world, the retiree who stays organized has a major advantage over the retiree who assumes everything will work the way it used to. This is not about fear. Fear is not a strategy. This is about principles. Understand the system you are operating in. Do not fight incentives you can design around. Do not create patterns that make innocent behavior look suspicious. Do not rely on verbal explanations when written records are easy. Do not treat large cash movement casually. Do not wait until a bank manager is already asking questions in a private office. If you remember only one thing, remember this: the rule did not become dangerous because $10,000 is a large amount of money. It became dangerous because $10,000 is no longer a large amount of money, but the system still treats it like one. That mismatch is what catches people. A number created for a different era is now sitting inside a modern surveillance, compliance, and reporting machine. When old thresholds meet new technology, ordinary behavior can become suspicious by accident. The way to protect yourself is not to panic. It is to reduce ambiguity. Make the transaction understandable before it happens. Make the purpose clear. Make the record clean. Make the pattern natural. Make the bank aware. Make the tax reporting reconcilable. Make the system see what is true, because if you do not define the transaction, the system may define it for you. And systems are not known for their mercy. They are known for following rules. So your job is to make sure the rules see you correctly. That is the quiet discipline that protects your money. Now, not cleverness, not secrecy, not hoping no one notices clarity. Documentation process. Those are the principles that matter. And if you follow them before you need them, you greatly reduce the chance that your own money becomes unavailable at the exact moment you need it most.